Hello and welcome everyone. I'm Robert Baharian and this is Masters in Investing. They say life never stops teaching and we never stop learning. This show is my exploration with investors to both understand and unpack what is going on in markets right now and what this means for business and for investors. Please don't forget to subscribe and leave us an awesome review. Let's get into it. My guest today was the Chief Economist for one of Australia's largest ETF providers, managing in excess of $17 billion, David Bassanese. During our conversation, we talk about the collapse in the tech names all around the world whilst the broader stock market continues to edge higher. We talk about inflation, we talk about valuations and what all of this means for investors in 2021. We also talk about the role of bonds and fixed income in portfolios. We talk about the Australian property market, and we also find out what David really thinks about privatising some of Bondi's premium beachfront. I hope you enjoy my conversation today. David Bassanese, the Chief Economist for one of Australia's largest ETF provider, managing in excess of $17 billion of investor money, BetaShares. Welcome to Masters in Investing.
Great to be with you.
David, if you look at the market right now, you look at some of these big tech names that have sold off from some of their highs from 6 months ago, 12 months ago. And I've got some numbers here. Spotify subscribers are up 21% year on year. Spotify stock is down 44% from its 52-week high. Square's gross profits up about 80%. 28% below its 52-week high. If you simply look at those numbers and you looked at nothing else and you asked somebody, what do you think's going on in the stock market right now? They'll probably tell you that it's a bloodbath and the market's just hemorrhaging. But that's not what's happening in the market at the moment. Can you just give us a rundown of what you're seeing and what your point of view, David, is as to what's going on in these subsectors of the market as well as the broader market as a whole?
Yeah, look, I think, you're right. I think you've got to unpack a few things going on. First and foremost, the overall global equity market is actually only a little bit off its highs. So the overall global equity market, as you know, we bottomed in March last year on the recovery trade, and really the market has been trending up ever since late March now of last year. Now, what we've seen is we've seen a rotation within equity markets. So we've seen a rotation from the so-called the tech names that some of that you mentioned. So technology generally was outperforming prior to COVID. So growth technology, the FANG stocks, the Googles, the Amazons, and Facebooks. COVID came along and funnily enough gave them an extra oomph, an extra kick along because they became, the defensive trades when people are, the lockdowns basically meant people were shopping online, working from home. So anything with a technology flavour and certainly promoting, working from home, shopping online, got an extra period of outperformance. And so what we're seeing within the overall equity market is an unwinding of that COVID premium, if you like, to some of the technology names. And a more general, and particularly some of those higher, some of the ones that you mentioned are pretty richly priced. Some earnings behind them, but it's still, they're probably the more, growth, speculative parts of the technology market. Companies like Google, Amazon, Facebook, they're off their highs, but certainly nowhere near to that extent. So I think there's a few things going on. There is a rotation from the things that did very, very well during the COVID shutdowns, and particularly some of those higher priced, less proven, business models. They got a lot of potential out there. But how they go in the new COVID world, I'm sure they'll do okay, but I think they probably got a little bit overly bought during the COVID shutdown. So that's really. Do
you think a lot of that was being baked into the price last year, and now is it? David, do you think that there's an expectation from investors that growth of some of these companies just had to keep growing and whether it's growth in subscriptions, growth in top line revenue, bottom line, whatever it is, do you think there's an expectation from investors that it had to continue at this insane pace year on year on year to justify that price? And if once the company doesn't hit those numbers, you start to see the companies sell off. Do you think there's an element of that going on?
Yeah, there is. And look, I think also in the technology area globally, and particularly in the US, you've got to distinguish between the big blue chip, I mean, I could say blue chip, but like the big established FANG companies and the more smaller up-and-coming companies. And those smaller up-and-coming companies are pretty richly valued with a lot of earnings expectations priced in, a lot of hope. And they did get a massive, tailwind because of the COVID shutdowns. And I think what we're seeing now is really just the reality that COVID trade, that sort of shutdown trade is unwinding and people are seeking value in parts of the market that were beaten up, so energy, financials, consumer staples, infrastructure, travel companies, all of these sort of sectors got beaten up during COVID, have been rallying, since the second half of last year. And that's where I guess the money's gravitated to. So,
but why is that? What happened? What triggered investors to have this aha moment where they've realised that these particular companies relative to, so you talk about energy or financials or travel companies relative to that of the tech, like what happened for them to say we should now maybe allocate some of our money here and not at the FANG stocks again?
Yeah, well, I mean, I guess it does come down to relative valuations. I mean, what happened is, we're enjoying a V-shaped global economic recovery. So that's what's happened. And so if you think back to early last year, oil prices collapsed.
Yeah.
In fact, the futures price at one point went negative.
Yes.
And
so maybe just some of our listeners, David, can you just explain how a negative oil price even works? So are people literally paying you to hold? It's a futures
price. So it's the price of. Yeah, well, exactly. I mean, the thing is when you buy, it's a little bit. I'll try to explain it quickly, but I mean, basically when you buy exposure to the oil market through commodities, you're not buying physical oil. You're not. Well, some people can. Like some hedge funds go out and buy container ships of oil and then park it offshore. But the average, investor buys a futures contract, so it's the right to delivery of barrels of oil at a price in the future, at a time in the future. Now, what happened briefly last year was there was an excess supply of oil and storage facilities were very in short supply. So it's actually quite hard to find a place to where to store your oil if you were to end up taking delivery of that oil. So it went negative, just pricing in the storage costs of basically taking delivery of that oil were you to hold that futures contract when it expired and then, be expected to take delivery and then try to find a place to store it. So it was essentially like it was a glut of supply in the market during the shutdowns of COVID that caused that negative futures price. The spot price never actually went negative; it went pretty low, but that's really what explained that situation.
Sure. Maybe if we can just go back.
So just backing up. I mean, so energy prices collapsed, bond yields fell a lot, and they've all rebounded. And that basically rising oil prices, rising bond yields tends to support the value parts of the market, such as energy and financials. That's I think accounted for that. Plus, the people are, working, have left their homes, shopping in stores, going to the offices, and so that COVID trade has unwound a little bit. So that's essentially what's I think happening. And really, what we've seen is that COVID, the recovery has been stronger and faster than expected. So that switch from the tech companies benefiting from the shutdowns to the more traditional companies has been, pretty fast because of that V-shaped recovery that we're essentially enjoying.
You're in quite a fortunate position, David, where your company also has full visibility as to where investor money is flowing through the suite of your products. What insights are you gaining now with that benefit? What is it that your team is seeing as it relates to where money flow is going at the moment?
Yeah, look, you're right. I mean, look, first, we actually do see a lot of two-way flow. So, for example, we have geared funds which go up, sort of give you, leveraged exposure to the market. We also have short funds which go, they benefit when the market goes down, when the equity market goes down. So people often ask us, well, what's the flow? Is that telling you anything? And to be honest, when the market falls, you get two-way flow. You get people that are buying the dip and you get people that are selling. So those flows don't actually reveal a lot. Even when the market's rallying strongly, you see people, wanting to buy the bear funds to I guess, hedge their position or anticipate a market correction, and others buying into it. But what we're also seeing is things like that growth to value rotation, as you mentioned. So a lot of our technology type of exposure, such as the NASDAQ, I mean, that was going very well. And it's still going well. We're still getting steady supply into there, but probably we're seeing a switching of investor money to some of those value parts of the market, like global banks, global energy producers, European, Japanese equity. So non-US, non-technology flows have certainly picked up in interest. So we are seeing that sort of growth to value trade, the rotation as it's called. As we're seeing it in the market pricing, it's also reflected in the flows that we're seeing. I mean, one thing we're also seeing is just ongoing growing interest in, getting some international exposure through ETFs, because it does offer you that, very much easy, if you want some exposure to global companies, you can just do it on the ASX now. So definitely hold your blue chip stocks that well in Australia. But if you want that international exposure, that's been a very steady source of, growth in the ETF industry in recent years.
You're no doubt speaking to a number of folk in industry, investors and wealth managers and financial advisors around the country. What is it that is of great concern to them at the moment?
Yeah, well, I mean, I think one ongoing concern, and I'm sure you have it, is how to give people income, how to give investors income without being, fully exposed to the equity market. So some people with their risk profile, their stage in their life cycle in retirement, to have 100% exposure to the equity market, you got to deal with the ups and downs of that. But meanwhile, cash and bonds are offering such a low return. And so it's that search for defensive yield, if you like, thanks to, central banks having slashed interest rates, is, I think, still the preeminent challenge for financial planners around the country. The other one, just in terms of markets at the moment, of course, we're seeing the reopening trade, the very strong rebound in economic activity, not just in Australia, but particularly in the United States. Demand is getting ahead of supply. We've had a lot of fiscal stimulus. We've still got, production bottlenecks. So we're seeing some inflationary pressure pick up. We've seen commodity prices rise very strongly. So there is a concern about, is inflation going to get out of hand? Will interest rates rise too far, too fast, which is going to hurt? Funnily enough, you do want higher interest rates, but then again, you don't want them going too far, too fast that it, causes a crash in the equity market. So that's the concern about, inflation coming back in a big way would be the major macro concern at the moment. Now, I personally think that is a short-run risk. I think, there is a risk of a bit of a market pullback or correction as we get a bout of higher inflation in the short run. But longer term, over the next 2 to 3 years, I think inflation globally will basically settle down again for structural reasons, geography, globalization, technology disruption. Those things haven't gone away. But we are going to go through a nervous period where we're not sure whether the lift in inflation that we're likely to see, particularly in the US, is only temporary, or maybe the start of something bigger.
What do you think it is, David? Do you think it is a long and windy road until inflation really gets... Because you look at some of these numbers, you look at core PCE, which the Federal Reserve look at, and it's well and truly below the 2% range that the Federal Reserve want to keep it at. You look at long-term CPI in the US, you can zero in and manufacture any kind of narrative that you want. But once you sort of take a step back and have a look at the long-term trend, one, that looks on trend. Two, core PCE that the Federal Reserve looks at is below the 2% threshold. The one big thing that came out last week was retail and food sales, which was just this total abnormal spike up, and that looks really interesting. So what's David's perspective on all of this, and what's BetaShares' point of view on inflation?
Yeah, well, look, I'm not a believer that we're on the cusp of an inflation breakout, something going back to the 70s and 80s. Look, like the world is different today. Back those days, we didn't have globalized markets to the extent we had today. For good or bad, the average worker, didn't have the bargaining power. They don't have the bargaining power that they did have 20, 30 years ago. A lot of wage contracts back in those days were inflation linked. So the world is just very, very different. But, you mentioned the core PCE, which you're right, the Fed does target. Now, we've already got an early CPI number in the US, which came out last week, which was actually the annual rate of core consumer price inflation on that number has now gone up to 3%. And it's looking like that's probably going to flow through to the PCE over the next couple of months. So as you mentioned, it is currently below 2, but it may well break above 2 over the next few months. And that's, as I said, that's why we're going through a nervous period where it is going to be above, higher than we're used to, I think, for a few months. But again, I think it's only a short run reopening trade associated with, dislocation in basically supply chain bottlenecks. Also, what does supply chain bottleneck mean? It's basically, the government has given consumers a lot of money to spend. They've increased unemployment benefits. We had JobKeeper in place for a long time in Australia, but even in the US, they had a lot of household income, income basically given to households. So spending has run ahead of the economy's ability to produce goods. And that's what we're seeing now as a pickup in pricing.
But David, isn't also that related to, from what I read and understand, that even in the US there is a shortage of good staff, so companies can't find employees to come in and open the doors to the shop and sell whatever goods or services that they're selling, because a number of them are still on government benefits at home, which I think it's September when the US, their version of our JobKeeper runs out. And so do you think there's just this a bit of a wobbly period between now and then until such time as we see how that unfolds? Is that kind of the base case in your mind?
Yeah, look, you're right. So in the case of the US, in the areas like hospitality, restaurants, bars, those sort of areas, as wages for workers in the United States are pretty low, right? And they're pretty low. The minimum wage there is very, very low. So the government, in its desire to, help people out during the shutdowns, actually increased the unemployment benefit that you normally get from state governments. So the federal government gave this extra amount of money. At the same time, they wanted to increase the minimum wage, but didn't get it done. So the minimum wage didn't go up. So as you said, in some areas, it's, people have done the calculations. They actually get more money being at home on unemployment than going to, wait on tables. Now, and that's attracted a lot of attention. But end of the day, that is obviously a small, it's not the whole economy. It's a small part of the economy. But in those areas, there is clearly, I suspect, at the margin, what you say is correct. There is a supply shortage of workers. And, the response there is to increase wages, ultimately, if you do want, and there's nothing to stop, restaurants and bars and whatnot increasing wages if they possibly can, which is ultimately what, we want to see, is we want to see higher wages to some extent. That's the whole part of this stimulus package. But it's funny, when you get it, people don't like it. So they want it, So I wouldn't exaggerate the impact of that across the broader economy. And as you point out, to the extent that the unemployment benefit is creating this work disincentive effect, it is going to be fairly short run, in the sense that those unemployment benefits are going to drop back down again in September.
And in terms of inflation, obviously it's supportive of some sectors, as you've talked about early on in this conversation. But why is inflation bad? especially from the levels that we are at now. Can you just explain why that's a bad thing for stocks and for other maybe risky investments?
Well, we actually want to look. At the moment, central banks, their biggest problem is not that inflation's too high; it's that it's been too low. So the central bank of the US has an inflation target of 2%. We have a target of 2 to 3%. Now, prior to COVID and up until the last couple of months, it's been consistently below that number. So that's why we've had interest rates so low for so long. But you don't want too much of a good thing. So they want a little bit of inflation, like 2%, just to sort of keep the wheels in, and just to back up, why they don't want really low inflation is that if you do get an economic slump, it's more likely you get outright price declines, and that can make getting out of a slump a bit harder. Because wages tend to be rigid in nominal terms. So that's the argument, to have a little bit of inflation and not allow it to go negative. Now, why you don't want it to go too high, like 4, 5, 6%, is that it basically adds to a lot of business uncertainty. It can lead to businesses cutting back on their investment. Their hurdle rates for investment go up. And also, particularly for asset prices, if inflation's running at 5 or 6%, then bond yields are certainly, and interest rates are going to be a lot higher than what they are today. And that would mean that equity valuations and housing valuations would come down. So asset prices around the world have been inflated over the last couple of decades because of this, trend decline in interest rates and inflation. So if that were to change, hold on to your hats, because it would put a lot of downward pressure on asset prices.
But how quickly could it rise?
Inflation?
Yeah, how quickly could it rise, though?
Well, again, I think you got to distinguish between a one-off hit to inflation, as we're seeing at the moment, I think, and a process. Inflation really, ultimately, to be sustained, is a process. And it's whereby, you get a cycle of wage increases and price increases, and each one competing against the other to get a real income increase. So wages go up in the response to prices go up in response to wages, and we get in this cycle. And that's what we had back in the 70s and 80s until, central banks came in and clobbered the whole situation, and then we opened up the trade to global markets, and we got a lot of tech disruptions. So it all went away. But so how quickly? I think, the example, going back to if you go back to the 60s and 70s, it actually started at quite a low level and gradually increased through the 60s. No one thought it was a problem, and then it exploded higher.
Until it became a problem.
What helped in the 70s, of course, is that OPEC at the time tripled the oil price. And so when you triple something which at the time was a pretty important price in the economy, that was a cost shock that went right through the economy, and businesses and workers competed to not be the ones to carry the can for that higher oil price. And that's why inflation did break out. But in the moment, look, if it is a process, barring a shock, I don't see OPEC or anyone having that control to do that anymore. It would be a process that would gradually happen over, 2 to 3 years, I think. But yeah, so it would be gradual enough for central banks to react. But what ultimately it's unlikely to happen, to be honest, until we get to full employment. And that's why, I think at the moment, I wouldn't get overly concerned, because I think you've got to wait till the US unemployment rates hit at least 3.5%. It's still in the high fives. And that's when if you're ever going to get decent wage growth across the economy, the unemployment rate probably needs to be a lot lower than it is at the moment.
When you look at interest rates or inflation and then interest rates historically, what the data say is that up until, I think it's like 3.5 or 3.6%, this is since the GFC, risky assets or stocks typically move in the same direction as rates up until about 3.5 or 3.6%, and then they start moving in the opposite direction. That's what the data say from 2009, since the GFC. What's your point of view on that? Do you feel as though that's the path ahead for us in the situation that we're in, or do you think again it's different this time?
Well, I think what you're pointing to is the fact that in the early stages of an interest rate cycle, so basically when you come out of a recession, central banks have got rates incredibly low to deal with a downturn. Then they start initially putting interest rates up because, the economy is recovering, demand is strong, earnings are strong. So that's a period where equity markets can rise even as interest rates rise because they're rising from a low level to a higher level. But as you said, if you get to the later stages of a cycle where, unemployment's very low, central banks are worrying about inflation picking up and they start pushing rates higher, like into restrictive territory, that's when the tipping point happens. And that's, as you said, so beyond a certain level, when interest rates go from, low to normal to average, let's say, and then from average to high, that's the tipping point for equities. But I wouldn't have any hard and fast rules about what the tipping point is. I would just say at the moment, I think the outlook for equities is still okay until such time as we get back to full employment. And that's when, and what is full employment? It's certainly in the case of the US, at least 3.5%, which is, we got down to those levels prior to COVID. And at the moment, so we've got a runway of growth that we can let the economy run before we need to worry about central banks raising rates. And again, they may never raise rates to the way to cause that major correction, because it may turn out that because of globalization, because of technology disruption, even at 3.5% unemployment rate, we just don't get the wages growth. And so I'm actually open-minded about, where interest rates may go going forward, because I personally don't see the case for an inflation breakout because of wages, because I think it's a different world to what it was, a few decades ago, back when we did have these quite, clear cycles of, not too hot, too cold in terms of the economy.
You mentioned so presumably then, until such time as though employment or those in the US go back to employment and the government benefits are cut off, like really the next June, July, August, I mean, how much do you really make out of that until we cross the line in the sand? You mentioned, you talk about equities, and you remain, if I'm reading between the lines there, still optimistic or bullish. I'm not sure how strong of a word that might be coming across to you, but can we talk about equities for a moment? We talked about tech stocks at the beginning. We talk about a rotation from those growth-orientated tech giants to those more undervalued stocks. When you look at global stock markets around the world, let's just use the US because it's a really, really good example. Valuation historically looks bloody expensive. You look at forward earnings, you look at the cyclically price adjusted earnings, or the CAPE, and that's sitting at like 34 times, which is the second highest since the tech wreck back in 1999. Yep. Like, you look at some of these things, and I guess the question is growth at what price? At what point in time does enough become enough? Because the more we pay and the more investors pay for something today, they're giving that up for the future. So the less I pay for something today, the greater my expected return. The more I pay for something today, the less my expected return. And so when you look again historically, when you're buying equities at these levels, the future earnings 7 and 10 years out, it's just bloody low. It's like 3 or 4 or 5% at best, with a really high correlation between the two. So the numbers say the more you pay, the less you get. The less you pay, the more you get. Like, what's your point of view on price and growth at what price?
Yeah, look, I have a kind of my first way to maybe one way to think about what's going on in financial markets is, first and foremost, central banks they've basically gone from worrying about inflation being too high to worrying about it being too low. So in the last couple of decades, they've slashed rates to near zero levels. And so as a result, and then they promised to keep them very low. So what we've seen is that the returns on fixed income markets like bonds has gone through the floor, right? So very weak long-term fixed income. Now, the way I kind of think about the equity market, people say, oh, the P ratio, valuations are high, but it's because of interest rates are, low, so it's pushed up valuations. But, the long-run return for it's still a bubble because the long-run return for equities is now lower than it was. Well, I think basically what I think, bigger picture here is the market is re-equilibrating to the fact that the long-run return from bonds is collapsed. And so when you think about it, equities and bonds are two competing assets, the two major assets. Now, equities generally give you a higher return over time compared to bonds because they're more volatile, they're riskier. But if the long-run return on bonds goes down, then to re-equilibrate, the long-run return for equities also has to come down. And, it's not that they two will equal, but the margin... to re-establish the margin between the two. So in a way... So
are you talking about, David, a premium between the two? So if one's going down, the other one's sort of following, but it maintains some level of premium above the other.
Just simplistically, let's say the long-run return for bonds used to be 5% and for equities used to be 10%. So the premium was around about 5%. Now, say the long-run return from bonds has gone down to 1% and the premium for equities is still 5%. Then your long-run expected return for equities drops from 10 to 6.
Sure.
Now, how does that happen? The PE ratios go up. So some people might say, oh, look, the long-run return for equities is poor. I've got bad news for you. It probably is right, but relative to bonds, it's still going to be better. And it just comes back to the fact that, central banks, for good or bad, have cut rates, and it's changed valuations around the board. So the good news for investors that have been in the equity market during this enormous rally is the market pricing. The higher the valuations go, as you point out, the lower the longer run return. So you enjoy the ride while it lasts, but if you're getting in, now, don't rely on the returns you used to get, decades ago for the equity market because, they are going to be somewhat lower. But that doesn't necessarily mean it's a bubble. What's happening is the market is readjusting to the valuations in the bond market until such time as central banks change their mind on interest rates. So bottom line, yes, valuations are high. Yes, the long-run return from equities is less than what it used to be, but it's all part of this re-equilibration, if you like, of the markets.
That's a really interesting point. I think I agree with you to the extent that it's a game of relativity rather than in absolute terms. I mean, if you look at it in absolute terms, then the returns look pretty mediocre from equities, especially when investors have been used to 15% per annum for the last however many years. And it kind of does feel like we've been talking about and saying the fact, you should expect low returns going forward. It's like we've been saying that since 2013 or 14. It's another 10 years we've been talking about it. But I don't disagree with you, and I think it is a game of relativity. And it goes back to the original question that you find that people are asking you, and what people are searching for, which is especially in an aging demographic and in the hunt for yield and income. People need to take some level of risk. And so on that note then, what are you seeing, David, as a wedge to help solve the income and cash flow problem without going so high up the risk spectrum?
Yeah, well, look, there's a few... Look, in terms of... There's different ways to look. In terms of something outside of the equity market, I mean, obviously the traditional ways are cash, fixed rate bonds, and then equities. And look, something in between that's become incredibly popular, talking about flows. And, we have launched an ETF in this area because it's giving access to an asset class that was otherwise harder for the average investor to get access to is something called hybrids, for example.
Yep.
That's something in between. It gives you, like bank hybrids, for example, they give you a reasonable yield, 3.5%. They also give you like franking credits. Now, this is something that is correlated with the equity market. So if the equity market sells off, the value of hybrids, because it's a credit product, the credit spread tends to widen, so the value of them go down. But if you look at it historically, they definitely go down much less than what the equity market does. And on average around about 1/3. So if the market, heaven forbid, was down 30%, the value of hybrids historically might be down, say, 10% going forward. Now, no guarantees or anything, but that's just historically the way it's worked. And effectively, when you're buying a hybrid, I basically simplify it. You're buying in the case of, say, Australian bank hybrids, the thing about them is if a bank in Australia were to get into financial difficulty, those hybrids can be converted into equity, and potentially your equity can get wiped out, right? So that's the risk you take when you buy hybrids. But what you're basically getting is it's the tail. You're basically getting paid for the tail risk of a major bank getting into financial difficulty in Australia. So it's a small probability of a terrible thing happening, but you're getting paid a good income for that, taking that risk. Now, and I say to people, if you're worried about banks going under, and I don't want to hold hybrids because banks are going under, well, have a look at your portfolio, your share portfolio.
You've already got the exposure.
If banks go under, your equities are going to be toast before the hybrids are toast. So,
yeah.
So anyway, just in terms of that, there's no easy answers, but that's one type of asset class that sits somewhere between equities and traditional cash and bonds, still offering a reasonable return. You're taking on a bit more risk, but it's something, in between those two. And we've seen, a lot of strong flows into our hybrid ETF. On the back of investors searching for yield, something outside of the equity market, for example.
And this might be an asset allocator's question, but you talk about these types of securities and their valuation being at risk, meaning they can go down.
Yep.
Maybe rarely do they go up as much as they go down.
Sure.
And so when you allocate your cash to these things, would you allocate them with some level into your sort of risky bucket, given that they do have that element of risk, or do you see people sort of allocating them into 100% into the defensive bucket of their allocations, or is that something that you may not just have any insight on?
Look, it's really horses for courses to how you want to describe what a hybrid is.
Sure.
It's something between equities and traditional bonds. In so it's really, how you want to label it is really up to you. What I can tell you is the volatility of something like hybrids is certainly much closer to bonds than it is to equities. And so let's say like the standard, I don't want to get too technical, but the volatility of returns in equities is something like 20-odd%. So, around an average return of let's say 10% average return for equities in a year. It's maybe not that anymore, but on average,
you said it's 6 now, David. We've got to lower our expectations, right?
Yeah. So let's say it's 5. Let's say it's 5%, just
Sure.
For a number. So the standard deviation of returns is 20%, which means that there's 2/3 chance that equities will be, anywhere between +25 and -15. That's the sort of range of volatility in any given year. Now, bonds, by contrast, the variation is around about 3 to 5%. So 20% versus 3 to 5%. Now, hybrids generally have been probably around that 7 to 8%. So they're higher than bonds, but certainly considerably less than equities. So what you want to, how people name that's really up to them. There's no legal thing, it's
Sure.
One's defensive and one's growth or whatever. It's really up to the advisor or the client, the investor, as to how they want to. It is what it is in terms of the return and the volatility, and how you want to label it and use it is really up to your decision.
Can we talk about the property market and maybe move on to that, if that's okay?
Yeah.
What we've seen over the last few months, and especially since the beginning of the year, this sort of warming up or fanning of a a warmer or even hotter property market. Auction clearance rates are, I think last week they came in at like high 70s, 77, 78, but they've been, 80 plus in the weeks prior. What's going on there? Is it a function of banks' willingness to lend? Is it a function of people's pay going up and having greater surplus income to direct to mortgages? I think we all are familiar with the family wants a bigger house with a study or a backyard, and apartments have been absolutely toast over the course of the last 6 months or so for those reasons. So I sort of get that narrative around the upgrades. But where is this money coming from in order to fund the bigger house, the bigger mortgage, etc.? Where is this money coming from?
Yeah, good question. I mean, look, first and foremost, I think what the driver has been is if you think about Australian property here, just talking about nationally, we've had prices relative to, say, household income for the past 5 or so years had actually gone sideways. So we've had a period where we had a rise in prices, then we had a fall. Sydney and Melbourne prices prior to COVID were falling there for a while because we had macro-prudential controls come in, tighten the credit conditions, and prices were falling there for a while. And then COVID came in and they fell a little bit more. So over the course of like a few years, they've actually gone sideways. On top of that, now you've had the RBA cut interest rates to, record low levels. People have been able to get a fixed rate mortgage at, 2% or something, just crazy. So mortgage affordability nationally, and I did a blog about this on our own website a few months ago, saying it hasn't been better in 20 years. So at the start of this year, on the back of house prices having gone sideways, the RBA slashing rates. It was, if you could get the deposit, if you had the mortgage deposit, the percent of income for someone on average income to buy a medium-priced home was the best it's been in 20 years. So that was the match for the market to recover with the V-shaped recovery that we've been enjoying from COVID. So that's affordability, is the key driver there. But affordability wouldn't trigger it were it not for the V-shaped recovery we're enjoying.
The economic recovery.
Yes, the economic recovery from COVID. We've dealt with COVID pretty well. The unemployment rate has come rushing in. And I think to some extent also it is a bit of a catch-up from a lull. Obviously during much of last year, the housing market was pretty dead. You couldn't even go out to an auction to see so we had a period of pretty weak activity. So part of what's going on is catch-up. But I think the key driver is just that, affordability and the economy recovering. Now, so where's the money coming from? It's, low interest rates. What we see in Australia, when central banks slash interest rates, when they cut rates, people don't suddenly say, oh, now I can buy a house and don't have to spend as much on the house. I can buy something else. What they do is they go out and bid more for the house. So the benefit of low rates is pretty quickly capitalised into the prices. And that's what we're seeing. And as a result, the downside of this is when and if the RBA does eventually raise rates, I think it'll have a pretty quick effect in cooling the market. Now, not crashing the market, but at least cooling the market. And I think one other interesting thing, the pessimists out there about housing for many years said, housing will hold up until we get a recession. And when we get a recession, that's when the market will crash. Well, we got a recession last year, but the government basically bailed everybody out because it was a recession caused by COVID. And so, I guess the view was it was a recession that was an undeserved recession. The economy crashed because governments told people they couldn't go to work and had to stay home and shops had to shut. So it was an unusual recession, is that even though unemployment did go up, which we would have thought would have forced a lot of people to sell their property and cause prices to go down, we had, JobKeeper, and we had banks basically giving people a repayment holiday. So the conditions for that crash that we thought might happen during a recession basically didn't come to pass.
I think NAB came out and said not like 98% of their loans are now back on track. So, it's gone from, this many being off track to now, a very small proportion. And I suspect that'll begin to normalise over the coming months as well, as you point out about having a V-shaped recovery. Who distinguishes an undeserving recession, David?
Yes.
So just picked up on that.
Yeah.
One, who distinguishes that? And then two, do you think going forward we're going to have these boom busts that are more flashy than they may have been decades ago, and central banks in and around the world are becoming far more entangled in economies and financial systems and playing a much larger role? So, sorry, there's like three questions there, but who determines the undeserving?
I got that term from, and this is one of the lessons of last year, was that when you think about the recession, so go back. Typically, recessions come about because of either two things historically. It's been either an inflation breakout, like unemployment gets too low, wages start picking up, and central banks actually deliberately start slowing the economy. And when you're actually deliberately slowing the economy to keep inflation in check, you can't bail everybody out, right? Because that's the whole point, is to cause unemployment, is to cause a slowdown. And that's going back in the old days, the 90s recession, the 80s recession. That's what a typical recession looks like. And that's why you don't get the bailouts. Now, the other type of recession is whether credit crunch, as we saw during the GFC. We didn't get a recession in Australia, but the US certainly did. And when you get like excess lending, we had something like that in the late 1980s. But when it's a credit bubble that bursts, again, you can't bail people out because you've got to let the system cleanse itself in a way.
But do you agree? Do you agree or disagree with the fact that the system didn't really get cleansed out because maybe households did not get bailed out, but corporations got bailed out?
You mean during COVID?
During the GFC.
Well, yeah. I mean, the US. This is where the US. It was the too big to fail problem. I mean,
That's right.
The banks in the US, rightly or wrongly, convinced regulators that they were too big to fail. If you let us fail, we're going to have an absolute implosion in credit conditions and have a Great Depression. Now, we'll never know whether that was true or not because they never let it. They never risked it. They did let Lehman's go bust, and it did create a mini implosion. But thereafter, basically, the banks were effectively bailed out through various reasons, and they never did get the cleansing. But as I was going to say, the difference with COVID was that because this recession was caused by governments basically mandating shops to shut.
Yeah, sure.
So it was a downturn, in a sense, undeserved. And so as a result, they were able to create support. So they said you can't go to work, or you can't open the shop. But by the way, here's a suitcase full of money to spend.
Sure.
So it was kind of a weird downturn, but. Where was I getting to? So that's what I mean by undeserved. And this time it was a recession that was undeserved. So we had a lot of stimulus supporting it. But I think what's going to be interesting going forward is this, if we have a recession for whatever reason next time, how quickly will they be bringing out the support?
Yeah. But also I think that there'll be an expectation from investors and the community and consumers that governments are now causing or creating a precedent that they are going to be involved.
Yes.
And so...
in the housing market, that's interesting because, again, we used to say the housing market won't crash until we get a recession. Whereas now some people will say, well, maybe it won't crash even during a recession because we're all going to get bailed out.
And so I'm genuinely curious whether or not these booms and busts are going to happen more frequently than maybe we've seen over the course of the last 50 or 100 years, just purely because of governments getting far more, or central banks getting far more involved, and governments for that matter, getting far more involved than they have been. Yeah. Understand the driver and the cocktail mix of ingredients, if you like, that have now created or caused property markets to be where they are, and it sounds like it's largely driven by those that can raise their hand and bid higher and higher price to get it to where it is today. And when you talk about cooling, if interest rates are going up, I think a lot of people have this impression that markets can either go one of two ways. They're going to go up or they're going to go down. But not many people talk about this concept of, you mentioned it before, this lull period where not much happens for a period of time, and that could last 12, 18, 24, 36 months. What's your forecast for the property market, the residential property market, from where we are today?
Yeah, and so, my forecast is I think we're going to probably have another 3 to 6 months of pretty strong conditions, like house prices going up. I do think eventually APRA and the RBA will step in and do so-called macro-prudential controls, and so they'll rein in, increase the borrowing requirements. Will make it harder for people to get a loan, essentially, and sort of cool the market without necessarily having to raise interest rates. And then the market will probably go through a sideways period of lull. And again, if you look at Sydney, we had a boom in the late 90s and then in the early 2000s, and then we went sideways for about a decade. So Sydney, from about 2004, from 2004 to say about 2012, not quite a decade, but we had a period where prices, rose maybe at an annualized rate of about 1 to 2%. So that was almost a decade of 1 to 2% prices, and it goes back to affordability. Basically, when affordability reaches a level that the average homeowner can't pay more for a home, there's only a limit to how far prices can go, right? I can't afford to pay $15 million for a home. Right. Now, I might be on an above average income, not, but I mean, the average homeowner, whatever the average income is, let's say it's $100,000 or $150,000 family income. Then if you do the calculations, you say the maximum amount an average household can spend on a mortgage is, say, 30% of after-tax income. You know how far house prices can go before the average homeowner can't pay anymore.
Yeah.
So that's sort of the limiting factor, and you can see it. There's an affordability index. Many economists have an affordability index, and you see historically when it gets to a certain level, house prices stop rising.
And where are we now in that cycle, David? On your affordability index?
Back in February, when I put out a blog, it was actually at quite low levels because house prices have gone sideways and the RBA catch. Now, at the moment, I don't think we're back at those peak levels yet, but I mean, I think over the next 6 months, we probably will get back to those levels. And if we don't, so again, if the RBA were to do nothing, house prices would keep going, and I'm talking generally here nationally, to a level where, the marginal buyer couldn't afford to pay anymore. And that's when the market would start to...
In fact, I think it was NAB that came out, their economics team, and had a forecast that prices will rise or are likely to rise a further 10% this year. And this is maybe a month or so ago now. Do you disagree or agree or somewhat disagree with that forecast?
Look, I'd be, 10% seems quite reasonable. I mean, I think the market is very hot and it's probably going to get hotter because the economy is only going to get better. And there's still a ways to go before central bank, certainly the RBA is still of a view not to raise rates for at least a couple of years.
Yes.
And that's why I think they'll do macro-prudential beforehand, but they won't do it until the market gets a lot hotter than it is now. So it seems to be only one way at the moment, in terms of the market.
So if you're looking to buy property, buy now before prices get maybe a little bit too high.
Well, it's funny, that fear of missing out is, driving the market, I guess, you're not... That's right. So
you're not wrong. What's two things? One thing that I'm really curious about, like in your mind, at the back of your mind, no doubt there is something there that you think about. You think, shit, if this happens, we could just blow up. Like, what is that risk that is in the back of David's mind that just creeps up from time to time and maybe just scares you a little bit?
Look, in terms of the macro economy, it's, I think ultimately, my underlying view here is that central banks are fighting the last war on inflation. I mean, I think inflation is going to stay lower than central banks are comfortable with for a long time. and because of the structural things that I've mentioned, globalization, technology, these sort of things. So they're probably going to keep rates too low for too long and maybe cause an equity bubble and or a housing bubble. So I guess what ultimately worries me is that by fighting the last war, central banks could create an asset bubble of the sort, we saw, maybe going back 20 years ago during the dot-com bubble days. But something, because even the dot-com bubble was, constrained mainly to the tech sector, but this could affect all markets. And so I do worry, and, you mentioned the moral hazard problem as well. If people think you're going to get bailed out with a sell-off, just be all in, right? Because if things go badly, you're going to get a bailout. So it's that moral hazard plus central banks chasing an inflation target, which is unobtainable, creating an almighty bubble in equity market, in asset markets. I don't think some people think we're there yet. I don't think we're there yet. I think it can go a lot higher before we get to that point. But that's the worry, I think I have. And so that's why, just watching the markets to see how it all plays out at the moment.
And so where's the big red X marked on the forward earnings or the CAPE ratio for David? Is it like 45 times where you say, I'm liquidating the equity portfolio now because this is just insane? Because the highest it got was 44 times in the dot-com bubble.
Yeah, well, again, so if you think about the S&P 500 in the dot-com bubble, it got to 25 times forward earnings.
Yes.
Now, would you believe we're at 22 times earnings today? But the big difference is the interest rates are a lot lower. So as I said, that looking at purely PE ratios alone is probably not the best thing. You've got to allow for low rates. And so if you think about it, the equity risk premium, so that's the market's earnings yield less bond yield, got negative, like the earnings yield of the market was, well below the bond yield. And so if we get to that sort of situation, so, depending on bond yield, if the PE ratio, could go to 40, it's at 22 today. If it gets to 35 over the next 5 years, that's a bubble, and this is, and again, if central banks keeping rates, if 10-year bond yields in 5 years' time are still only 2%, P ratio could go a lot higher. That's the challenge. And as I said, going back to what we were talking about earlier, the long run outlook for equities with a P ratio of 40 will be very, very low. But it'll be a good ride to get there.
Yeah.
The ride getting there will be beautiful. But once we're at that top, then the outlook won't be so good.
It's just like the good party that lasts for a little bit too long, right? And the answer might be the same here, might wrap up, David, is we're sitting here in the year 2023, 2024, and you sort of look back, what do you feel as though is the biggest regret that investors have from now to then?
Look, I think not being invested in the markets, I think, I think, equity markets are volatile. I think you're going to get setbacks along the way between now and, say, 2023, like corrections. But until we get to US full employment, which I still think is 2 to 3 years away, then the worry of a big recession is probably the big bear markets come with recessions. And I think we're still 2 or 3 years away before we could worry about a renewed recession caused by very low unemployment. So in the main, I think equities are going to continue to do okay. But if you're constantly worried about setbacks in the market and not wanting to get in, you may miss that over the next 3 years. And it's a bit like Sydney house prices. People don't want to buy Sydney prices because they're so expensive, and every year they watch them go even higher.
Melbourne's not too dissimilar. Look, David, I think you're right. As long as you're aware of the game that you're playing and the rules to that game, I think it's a sit down, buckle up, and let's just go for that ride. But understand that you could be doing this for the next 2 years and then absolutely dropping 15, 20 the year after. And I think as long as investors are aware of that, and there are, to some extent, no surprises, it makes the ride just a little bit easier to be able to digest. One final thing. I'm from Melbourne. And you're from Sydney, or you're in Sydney, or live in Sydney at the moment. From what I understood, that there was on Bondi, there was a private Italian style beach club that was going to open, proposed to be open. You're smiling. I heard from a little birdie that you were quite passionate about that. Why is that?
Oh, look, I'm on Twitter. I tweet about various things, the markets. I mean, I don't know if you're involved in that. Look, it was a proposal. I don't know where it's even gone, but I just read about it and I just thought.
You thought it was a shit idea. Why?
I lived at Bondi myself, opposite the beach there for like 5 or 6 years. So I do know and love Bondi, and I love the open to all nature of Bondi. And I just didn't like the idea of something being, walled off. And,
Mate, it was like 2% of the beachfront. There's plenty of space.
Well, 2% today, 4% tomorrow.
That's a good point. That's a really good point. They start off with this and then, slowly each and every year.
I'm all for private enterprise, but I'm all for, Australia. I love the open nature, the democratic nature of Australian beaches compared to, say, parts of Europe. I've been to Europe where you do have the walled off sections and you get your lovely deck chair and your cocktail and all that sort of stuff. It's very nice, but that was just my little dig about it.
Maybe something between Europe and Australia, maybe like a Balinese experience might be somewhere in the middle for you, David.
The hypocrisy of it all, of course, is that if it did open, I'd probably go and use the services.
I can see you there, man. I can see you there lounging in your banana chair, your blue and white striped beach towel. David, this has been awesome. Thank you so much for your perspective, your point of view. Maybe we can have another conversation when the PE ratio is sitting at around 26.5. We'll see where the world sits at that point in time. But David, thanks again.
No worries. Good to be with you.
Thanks, David.
Bye-bye.